It's Tuesday, 7th of July, 2026. Welcome back to your news update on Blip Brief, crisp, but almost everything updated every market trading day.
Let's dive right in.
Yeah, we need to bypass the noise and look directly at the momentum driving to Wall Street right now. Because if you look at the benchmark indices, the Sensex and the Nifty, they both logged higher closes. We're talking upward by nearly 0.75%.
Right.
And this is not, retail exuberance. When you look under the hood, the engine driving this domestic rally is entirely institutional. It revolves around a massive pivot in foreign capital.
You are tracking the exact right metric there. I mean, we are witnessing foreign portfolio investors, the FPIs, stage a highly aggressive comeback in the Indian equity space.
It's the whiplash that gets me.
Exactly. The whiplash is what makes it notable. Barely a fortnight ago, these same institutions were net sellers. They were strategically paring down their exposure today. They have completely reversed course. They are injecting capital with high conviction, and they are almost surgically targeting the financial sector.
Well, I want to break down the mechanics of that pivot, because institutional money doesn't just change its mind on a whim. What is the trigger pulling these foreign funds back into Indian financials specifically?
It comes down to a combination of mechanical market structure and, well, classic value hunting.
Okay, mechanically first.
Mechanically, we're seeing the downstream effects of global equity index rebalancing. When major global indices increase India's weightage, passive foreign funds, like the massive index trackers, are literally forced by their own mandates to buy Indian equities to match that new allocation.
So it's non-negotiable capital inflow.
Precisely. But beyond the passive flows, you have active value buying. Indian financials have noticeably underperformed the broader market rally over the last few quarters.
Right.
So their valuations became highly attractive relative to their historical averages. It practically provided overseas capital with the perfect entry point.
That influx of foreign capital targeting our financials makes the internal dynamics of the Indian banking sector incredibly critical right now for you to understand. And when you dive into the performance data across the sector, you find a glaring divergence.
Oh, absolutely.
The private sector banks and the public sector banks, the PSBs, are operating in two completely different realities right now.
This split is stark. I mean, if you look at deposit growth, which is the fundamental ability to attract savings, private banks are aggressively outpacing their public sector peers.
By how much?
They are maintaining a lead by a low single-digit percentage margin. And in a hyper-competitive banking landscape, a sustained margin like that is a massive structural advantage.
But here is where it gets highly contradictory. The private banks are dominating the deposit gathering. But when you look at credit expansion, who is actually lending the money out to the economy? The public sector banks are the ones taking the trophy.
Right.
So let me get this straight. Private banks are hoarding all the fuel by capturing deposits, but the public banks are the ones actually driving the car by pushing out loans.
That is a highly effective way to frame it, and honestly, it exposes a vulnerability in funding sustainability. A bank cannot outrun its own balance sheet.
Yeah.
Your ability to lend sustainably is permanently tethered to your ability to attract deposits. The private banks are using this period to build a formidable war chest. By capturing that deposit growth, they're securing the foundational fuel required to absorb future liquidity shocks.
While the public banks are stretching themselves thin.
Exactly. By aggressively expanding their loan books without, matching that growth on the deposit side, the PSBs are elevating their credit-to-deposit ratios to uncomfortable levels. They are running the engine hot.
And the timing here is critical, right?
It is the systemic focal point. Indian corporate entities are finally initiating their massive capital expenditure or CapEx cycles. For years, we saw corporations deleveraging, repairing balance sheets, or just turning to the bond market.
Right, but today?
Today, they need heavy banking capital. They need to construct factories, expand infrastructure, scale operations.
Okay, so if corporate India is showing up at the teller window asking for massive CapEx funding, and the public banks are already running low on deposit fuel, what happens when the tank hits empty?
You get a classic liquidity squeeze. If public banks want to keep funding this corporate expansion, they will be forced to compete aggressively for deposits. The only way to do that is to hike the interest rates they offer to savers.
Which hurts them.
Dramatically. The moment they raise deposit rates, their cost of funds shoots up. That immediately compresses their net interest margins. It essentially cannibalizes their profitability just to keep the loan engine running.
Wow. So corporate India is borrowing heavily to build and expand, which theoretically signals immense economic confidence. But if we track that capital down to the actual street level, to what you, the everyday Indian consumer are experiencing, the data presents a jarring contradiction. Let's look at the automotive sector.
It's an absolute boom.
Right. Vehicle retail sales hit a record high for the month of June. We're talking about a surge of over 20% year on year.
The momentum there is multi-layered. On the manufacturing side, the severe supply chain bottlenecks and semiconductor shortages that previously choked production have largely evaporated. Manufacturers are finally clearing out deep backlogs.
Pent-up demand.
Exactly. Plus, the adoption curve for electric two-wheelers is steepening dramatically, capturing a rapidly expanding market share. But the true engine behind this surge, the real factor driving that 20+% volume growth, is the rural consumer.
Yeah, dealerships in Tier 2 and Tier 3 regions are seeing massive footfall, specifically for entry-level commercial vehicles and two-wheelers.
Right.
But wait, this is where the macroeconomic narrative fractures for me. How can rural consumers be snapping up commercial vehicles and two-wheelers at record rates, while FMCG companies are simultaneously hitting the panic button over delayed monsoons and dry soil? I mean, the fast-moving consumer goods sector data is practically flashing red.
Because the FMCG sector is tracking the sky, not the credit markets.
Okay, unpack that.
They are watching erratic rainfall and a highly unpredictable monsoon. Current data shows Kharif crop sowing is down by over 20% compared to this exact time last year. For an FMCG executive, dry soil translates directly into an inflation risk and a severe contraction in future rural demand.
But I need you to reconcile those two realities. How can a rural household confidently finance a new tractor while simultaneously cutting back on premium shampoo or biscuits out of financial anxiety?
You have to separate the financing of capital assets from discretionary daily cash flow. When a consumer in the rural economy purchases a commercial vehicle, they're generally acquiring an income-generating asset.
Right.
More importantly, those big-ticket purchases are deeply insulated by specialized credit availability. Non-banking financial companies have aggressively penetrated the rural market. They make it frictionless to acquire a vehicle on an installment plan.
So the capital for the vehicle doesn't come out of today's wage.
No, it is amortized over years.
Though the auto boom is really a credit boom.
Precisely. But the FMCG data, that reflects the immediate visceral anxiety of the everyday agricultural worker. When Kharif sowing drops by over 20%, the daily wage laborer immediately foresees a collapse in their upcoming seasonal income.
So they tighten their belts today.
They downgrade to cheaper brands or delay purchases because their immediate cash flow is directly threatened by the lack of rain. It is a highly uneven K-shaped reality. Subsegments utilize structured credit to acquire assets, while the broader rural base contracts their daily consumption out of weather-induced fear.
And when you look at the corporate earnings landing on our desks, that split personality is fully visible at the enterprise level too. On one hand, you have Titan reporting a revenue jump of over 40%. That's driven by intense, unyielding demand for high-end jewelry and luxury retail.
Huge numbers.
But then contrast that euphoric consumption data with a governance reality check. Reliance Industries just received a formal administrative warning from the market regulator, SEBI, regarding insider trading lapses by its employees.
It perfectly encapsulates the complexity of the current market. You have segments of the consumer base exhibiting immense pricing power and discretionary wealth, as seen in Titan's margins. Yeah. At the same time, regulatory oversight on massive conglomerates is tightening. It ensures that as the market expands, corporate governance standards are aggressively enforced.
Now, that rural anxiety regarding the monsoons isn't an isolated domestic issue either. It seamlessly feeds into the broader narrative of imported inflation and our global macroeconomic positioning. We really need to pivot to the global crude markets.
Yes, the dynamics there are fascinating right now.
Because the dynamics playing out between oil pricing and currency valuation are highly counterintuitive. Global crude oil prices have taken a significant hit. Saudi Arabia just executed its steepest percentage price cut for its Asian customers in over 2 decades.
Which is massive. They are aggressively slashing the premium on their crude to defend their market share against non-OPEC producers.
Right. And a price cut of that magnitude from Riyadh should be a massive fundamental tailwind for the Indian economy. We import the vast majority of our crude, so cheaper oil directly shrinks our import bill, eases the current account deficit, and theoretically reduces the fundamental demand for the U.S. dollar in our domestic market.
Theoretically, yes.
But that is where the math feels broken to me. Despite this massive drop in the cost of our most critical import, the Indian rupee just fell to a multi-week low against the U.S. dollar. If we need fewer dollars to buy our oil, why is the rupee weakening?
Because domestic oil demand is only one variable in a very complex currency equation. First, you have the overarching strength of the US dollar index globally, which is driven by shifting yield expectations in the American bond market.
Get it? Sure.
Well, but the more localized mechanism driving the rupee's position is the strategic intervention by the Reserve Bank of India.
Wait, the central bank is actively keeping the rupee down.
They are absorbing the inflows. Think back to that massive wave of FPI capital buying into Indian financials that we discussed earlier.
Right, the institutional pivot.
Exactly. When billions of foreign dollars flood into the domestic equity market, it naturally exerts upward pressure on the rupee. To prevent the currency from appreciating too rapidly, which would severely damage the competitiveness of Indian exports, the RBI steps into the open market.
I see.
They buy up those incoming dollars to bolster their foreign exchange reserves, injecting rupees into the system. That absorption process naturally anchors the currency. It contributes to it settling at these multi-week lows despite the cheaper oil imports.
Okay, that explains the mechanics on the trading floor. But I want to bring this down to the street level for you, the listener. Wait, Samsung reports a massive multi-fold percentage surge in profits, but their stock drops by over 5%. Meanwhile, global oil prices are slashed, but Indian consumers don't see a drop at the pump. Make it make sense. Let's tackle the pump first.
It is entirely due to the delayed pass-through mechanism inherent in India's state-run energy sector. The oil marketing companies, the state-run entities that operate the fuel pumps, do not adjust retail prices in real-time correlation with global crude fluctuations.
Right.
During previous macroeconomic cycles, when global crude prices spiked violently due to geopolitical shocks, these companies acted as a buffer. They kept retail prices artificially suppressed to shield the Indian consumer from rampant energy inflation.
So they took the financial hit themselves.
They incurred staggering percentage losses. The industry refers to this as under-recoveries. Now that global crude prices have significantly dropped, the input cost for these oil companies has plummeted, creating incredibly wide profit margins at the pump today.
But they aren't passing it on.
Exactly. Instead of passing that discount down to the consumer, the state-run entities are utilizing these expanded margins to aggressively recoup those historical massive percentage losses. The consumer today is effectively paying back the implicit subsidy they benefited from several quarters ago.
Man. And while the energy markets are bogged down in these delayed reactions and historical recoveries, global equity markets are trading purely on the future. And right now, the future looks highly polarized.
Very polarized.
In the U.S., the tech-heavy indices jumped by over 1% in the latest session. It's this unyielding, momentum-driven rally fueled entirely by optimism around artificial intelligence and the semiconductor ecosystem.
The capital concentration in American tech right now is historic.
But the internal optics are brutal. This market exuberance is peaking at the exact same moment Microsoft announced sweeping job cuts, impacting roughly 2% of its entire global workforce.
Yeah, the efficiency push.
And if you shift your focus to the Asian markets, the tech narrative completely inverts. Korean markets dropped by over 3%. Leading that aggressive decline, tech giants like Samsung fell by over 5%. So let's get back to that second part of my question. Samsung profits multiply several times over, yet they're stock craters.
It is the ultimate lesson in how institutional capital actually operates. The stock market is never a reflection of the present, and it certainly doesn't care about the past. It is exclusively a discounting mechanism for the future.
Right.
When a titan like Samsung reports a massive percentage surge in profits, that data is entirely retrospective.
It's looking in the rearview mirror.
Exactly. Institutional investors and their algorithmic models had already anticipated that profit surge months ago based on memory chip pricing cycles. They had already bought the stock in anticipation. They had, quote-unquote, priced it in. When the actual earnings report drops, the market is no longer looking at the current quarter. They are forecasting 6 to 12 months into the future. If the forward guidance provided by the executives isn't utterly spectacular, large funds will immediately take their profits and liquidate positions. They sell the news, driving the stock price down sharply, completely ignoring the historical record profits.
That constant high-wire tension regarding forward-looking expectations brings us directly to the geopolitical friction points we are monitoring today. Because nothing creates forward-looking anxiety for capital allocators quite like a threat to global supply chain security.
Absolutely.
Let's trace that global energy discussion directly to the source, because the signals emanating from the Strait of Hormuz right now are dangerously contradictory.
It is a highly volatile theater.
On one hand, we are seeing aggressive kinetic action. Reports confirm Iran has fired missiles near commercial shipping vessels navigating the strait.
Yes.
But on the other hand, the diplomatic channels are broadcasting the exact opposite narrative. There are active, credible reports of a U.S.-Iran peace deal being brokered in the background, a temporary ceasefire being drafted, and the U.S. president issuing a highly public ultimatum to either lock down a definitive deal immediately or finish the job.
What you are observing is classic dual-track diplomacy. In high-stakes geopolitical negotiations, military posturing and peace talks do not happen in isolation. They happen simultaneously to maximize leverage.
Pressure tactic.
Exactly. A state actor will utilize targeted kinetic action like a missile launch near a shipping lane, specifically to force concessions at the negotiating table.
But let's look at the immediate tangible impact on India. Because despite those missiles flying, commercial traffic in the Strait of Hormuz has resumed. And as a direct consequence, the Indian government in New Delhi has actually lifted its emergency gas supply curbs.
Right. The physical flow of liquid natural gas, LNG, and critical fertilizer shipments are actively reaching Indian ports again.
Which is a massive relief valve for domestic agricultural inputs. But we also have to note the rising temperature in the east. Over the last 24 hours, China test-fired a long-range ballistic missile from a nuclear submarine directly into the Pacific Ocean. It's a maneuver that has severely rattled global allies and added another dense layer of geopolitical stress.
It certainly has.
So to summarize the geopolitical board, missiles are literally flying over critical shipping lanes, yet the Indian government feels confident enough to lift emergency gas curbs. Is the market just completely numb to geopolitical risk?
Numb assumes they aren't paying attention. The reality is that global supply chains and commodities markets have developed an incredibly thick skin based on empirical data.
Thick skin, how?
Commodity traders are highly sophisticated at separating political theater from physical disruption. A missile test in the Pacific, or even a targeted strike near a commercial vessel, generates massive, terrifying headlines. But traders watch the transponders on the ships.
They watch the actual movement.
Right. As long as the physical flow of commodities continues, as long as those fertilizer ships and the LNG tankers actually successfully dock at Indian ports and offload their cargo, the pricing models will largely ignore the political noise.
So they only react when the supply is actually severed.
Exactly. The market only prices in a crisis premium when the physical supply chain is mathematically broken, like when a port is blockaded or a vessel is actually sunk. Until that physical threshold is crossed, the prevailing cold logic of the market is that global commerce will always find a way to navigate through the friction.
Well, we're going to step away from the heavy macroeconomic machinery and geopolitical posturing to end on a fascinating technological innovation. We always look for a signal that proves exactly how fast the fundamental rules of the global economy are shifting, and today's innovation kicker delivers exactly that.
It's a great story.
We have been tracking the story of a Chinese university student who successfully built a fully functioning AI speed radar system.
It is a remarkable case study in efficiency.
Yeah, they didn't possess a massive engineering team. They didn't have a corporate research and development budget. Instead, they utilized an advanced AI assistant, specifically the Claude model, to write the underlying code, design the hardware schematics, and troubleshoot the system architecture. They went from concept to a fully operational system in exactly 9 days.
The technological achievement is impressive, sure. But the reason this is critical for you to understand is the scale of the economics involved.
Yeah.
We have to view this through the lens of productivity levers. This single student built a functioning, market-ready hardware and software ecosystem for an upfront cost equivalent to a couple of coffees.
That's wild.
And they then turned around and sold that proprietary system for an astronomical profit margin in the hundreds of thousands of percentage points. The return on investment is staggering.
I want to unpack the why behind that because it forces a complete reevaluation of what we consider a corporate moat.
It represents the absolute democratization of specialized capabilities. Previously, developing a radar system of this caliber required a team of specialized engineers, months of iterative prototyping, and massive corporate overhead.
Which was the barrier to entry.
Exactly. That immense capital requirement protected the incumbents. Now, an individual is utilizing an AI model not merely as a search engine, but as an extreme productivity lever to completely bypass traditional engineering workflows. It shifts the entire power dynamic of innovation.
So the big guys are losing their edge.
We are moving from an era where massive corporations dominate technology development simply because they have the capital, to an era of agile individuals who understand how to effectively prompt and guide AI systems to execute incredibly complex tasks at near zero marginal cost.
If a single university student can disrupt a highly technical hardware market in 9 days for the cost of a coffee, what happens to traditional corporate structures when every single person entering the workforce possesses that exact same capability resting in their pocket?
It changes everything.
It is a complete paradigm shift for anyone managing a career or portfolio today. It forces you to seriously question what the very definition of a company will even be a decade from now. Something profound to chew on as you head into the trading day. Just before you go, a quick note. This deep dive commentary was put together using advanced AI. We always strive for accuracy, but please do cross-verify any crucial information yourself. Your informed decisions are what matter most. The content shared here is for informational and educational purposes only and should not be treated as investment or trading advice. Past performance is not indicative of future returns. We are not licensed financial advisors.